Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and I'm joined today with a brand new guest on my show, a special guest. We're going to be discussing precious metals today, Mark O'Byrne. I'm very honored to have him on the line with me. He's with goldcore.com. They're a bullion dealer, but they also specialize in storing your bullion, having it somebody else store it for you. I know some of you might be concerned about some sort of counterparty risk, but he'll explain that here today. It is your physical bullion, and it's segregated. It's stored for you, and they have 15,000 happy customers. They're established in 2003. So let's discuss precious metals here today. Mark O'Byrne, thanks for coming on the show with me.
Thanks a lot for having me on, Kenneth. I've really enjoyed Cross the Street in recent months and years, and so it's great to join you at last.
Awesome. Well, appreciate that. Let's talk about the economy first, and obviously we're going to discuss how this settles and comes into the picture when it comes to precious metals. The 10-year bond now, yesterday actually was strongly over 3%. I think we've moved down a little bit from that, but it hit the highest level since 2011. And many say higher interest rates are signaling a stronger economy. Now, there was a sell-off a couple days ago in the stock market, which actually pushed rates up, which again is not because of a stronger economy, in my opinion. But overall, what are your thoughts on the rapidly changing interest rate environment?
Yeah, well, you summed it up quite well there. And I think the 10-year went above 3, and I think even as last time I looked, it was over 3.08. So we're heading towards 3.1%. A lot of the technical analysts are suggesting that a weekly close above 3% could see us quickly move up to 3.5%, and I think JP Morgan are talking about potentially going as high as 4%. And then, as you said, the question is that due to a stronger economy, or is that due to the recent sell-off in the stock market, or indeed is it due to inflation concerns, because the oil prices has moved up very sharply and it's above $70, and I think I would be leaning it, and like a lot of these things, there's probably a few factors going on. It's a combination of these factors, but I do think that the inflation story is potentially the biggest one, and we keep our specialty is precious metals. We keep an eye on the wider commodity markets as well. And that oil price is up very, very sharply, both year to date and over a 12-month period, as are a lot of the other commodities. I think we're beginning to see food inflation. I think it's going to start ticking up now soon. And indeed, I'm not sure about you guys over in the States when you put gasoline in your tank over there, but I know here in Europe, people are beginning to complain that they are seeing the price of a gasoline or petrol or diesel, as we call it, go up. So. No one knows ultimately in the short term what's going to happen with these interest rates, and it very much depends what happens in the wider markets, and particularly in the stock markets. And if you get a period of risk aversion and a sell from stock markets, then bonds could be bid up again, and yields could fall again. So, but the bottom line is, I think we tend to focus more on the long term and take a historical perspective, and interest rates are still near all-time record lows, and in the medium and long term, we believe they're going to go higher.
Yeah, Mark, it's one of those things. It's not apples to apples, right? 2011. I don't even know what the debt was, but it was a lot lower than $21 trillion here in the U.S. and obviously all of the unfunded liabilities that we have. It's a big deal to see 3% at these debt levels, especially with so much of the debt being short term. They're constantly refinancing this debt, unlike before where maybe a lot more of it was fixed at a certain level. So we're now refinancing into this higher interest rate environment. And, what is some of the implications on that? If you could just expand a little more on your thoughts on this. And you're on.
Yeah, absolutely. Yeah, absolutely. I mean, that's a key thing to be considered. So, people don't really think about it. They don't realize that, the debt levels in the U.S. have to be serviced, and this is the key benchmark. So, the national debt in the U.S. when back in 2000, when George Bush Jr. George Bush II came into power, the national debt was just below 4 trillion, and it went up roughly 1 trillion per year to roughly 12 trillion before Obama came into power. And then he put up the national debt roughly 1 trillion per year as well, up to around 20 trillion. And now I think it's heading towards 22 trillion since Trump has become the president. So, and that's just the national debt. There's also the massive unfunded liabilities. So these debts have to be serviced, and that's all well and good while interest rates remain very, very low. And we had near 0% interest rates. But as interest rates move back towards 3%, and potentially, as I said, JP Morgan talking about interest rates going to 4%, it becomes a lot harder to service those debt levels, and it just means that in time, the ultra loose monetary policies that we've seen in recent years may come back, and we may see quantitative easing resumed at some stage.
Yeah, I totally agree with that. Mark, stocks have been volatile in 2018, to say the least. We've seen it go up and down. We've seen a pretty long, just a short term, I think it was 9 days in a row, the stocks were going up. A couple days ago, it turned again. And I believe we're under, we're at a negative for stocks in 2018 as of right now. But much of this has been due to FANG stocks that have been responsible for much of the gains. What is your take on the stock market as it stands?
Well, it does look quite toppy. And I mean, the scale of the gains we've seen, as you said, it's sort of flatlined essentially this year. The S&P 500, I think it's essentially flat so far year to date 2018. But if you take a slightly longer term, medium term, and longer term perspective, I mean, the gains have been very, very significant indeed. And I had a look at just yesterday. The recent high on the S&P 500 was on January 26th. And as of yesterday, we were 2,711. So from 2,873 down to 2,711, it's near the recent record highs. But it's important to remember where we were not so long ago. Longer term, the resistance basically in 2000 and 2007. Resistance on the S&P 500 was 1,500. So gold peaked near S&P 500 peaked near 1,500 in 2000, and again in 2007. That was a huge level of resistance, and then it broke through that resistance in when was it? It was in 2013. So in March 2013, it broke through resistance, and since then there was nearly 100% gain in just over 5 years. Since it broke through that resistance. But from the bottom in February 2009, obviously we had a massive stock market correction and indeed some would say crash during the financial crisis in 2008, 2007, 2008, 2009. And the S&P went as low as 735. So today, as I said, we're 2,711, up from 735 in February 2009. So that's a gain of nearly 270% in less than 10 years, So that it does look long in the tooth. The business cycle also looks long in the tooth, and I think there is a risk of a sharp correction here and maybe even a crash. But to tell you the truth, we've talked this for a while, and we've been proven very wrong, and momentum is a very, very powerful thing. And technically, I think in the short term, some people are talking about a double bottom. So we could see more gains in the short term, and that big round number of 3,000, who knows? It very much depends on the wider macroeconomic backdrop and indeed geopolitical backdrop. So yeah, we would be nervous in the medium and long term, but I think in the short term, we could potentially go higher from here.
Mark, one of the things that is such a significant part of our economy is oil. And some are saying that this might change in the very near future here with the electric vehicles. But oil is very much headline news, and it hits everyone very directly because it's what we pay at the pump. Major part of the market. Many are saying oil is heading to $80 to $100 a barrel this year. So I'd like to get your thoughts on the implications on the market with oil rising, and maybe why is oil rising?
Well, it's interesting. We actually looked at today. There's an analyst who we cover here in the UK, Dominic Frisby, who's very good on precious metals in particular, and he writes for Money Week. And we keep an eye on his writings. And he actually did a piece specifically on oil today and how he's bullish I suppose in the medium term. I think he's talking about the next year, 2-3 years. And he's basically saying that we're in almost a stealth bull market in oil. Oil prices have been creeping higher for a while now, and it's only begun to make headlines in the very short term. And he made the point that technically it looks overbought in the short term, but he's very much strongly believes it's going to go higher in the medium long term. And I suppose the reason for that is it's the supply demand fundamentals. It's interesting when you look at the demand has continued, particularly from the growing middle classes in emerging markets, particularly in China and India. So that demand has continued to increase, and supply has increased as well, but supply hasn't increased by as much as demand. So I think that's a big part of it. But also it's the geopolitical backdrop. When you see what's happened in the Middle East, and the issues in Syria, and more recently what's happened with Iran. And Trump basically discarding the deal that was done in terms of the nuclear program in Iran. The geopolitical tension in the Middle East is as high as it has been, and then obviously just in the last day or 2 days we've seen in Israel what's happened with the protesters and whatever 50 or 60 people killed. I mean, this is a very volatile world that we live in, and the volatility in the Middle East is as high as it has been in a while. And obviously much of the supply of oil in the world still comes from that part of the world. So I think, again, short term, who knows? But I think in take a 2, 3, 4 year time frame, I think oil could do very well indeed, and then that feeds into the inflation story, and that creates a vulnerability in stock markets because, I think it could impact the stock market if you get that sort of stagflationary effect that we saw in the 1970s when oil prices went up very strongly, and the economy was stagnating. So I think that it is, but I think you lose it in the longer term. I think the move to more fuel efficient cars and indeed to batteries. I think so I think oil could be vulnerable in the long term. Particularly when you get the demand destruction because of the economy slow down, but also because of these move to new technologies. But I think that the oil story I think is quite strong in the short and medium term anyway.
Yeah, that's interesting. And I think that's what helped over the last couple of years to some degree is in terms of offsetting inflation is oil coming down and gas prices. Because it's such a big part of everyone's monthly bill, weekly bill is the price at the pump. And now we're seeing a rather quick turnaround on that. And that's Main Street right there. So we'll see how that really starts to trickle in as things go forward here. Mark, oil is a major component in mining, as you know. What do you think higher oil prices will do for the mining sector, considering it's one of the largest costs on the income statement, the balance sheet?
Exactly. It is indeed. It's a hugely energy intensive industry, and it hasn't become any easier in that regard in recent years. And in some ways, it's harder, particularly on the gold mining sector, because the gold mining companies are finding it harder and harder to find gold, and they're having to go deeper and deeper, down into the ground, deeper and deeper, and it becomes in some ways even more energy intensive. So. Yeah, it does create a headwind. It's a funny combination because obviously higher oil prices tend to be gold and silver tend to be quite correlated with higher oil prices, and that was seen very clearly obviously in the 1970s, and because gold and silver are hedges against inflation, and when oil prices go very significantly, then you tend to get quite serious inflation or indeed stagflation. So. But at the same time, I think that this is what you're alluding to. The cost basis for these and the cost of production per ounce for these mining companies, it can be difficult. So they have to be very careful in that regard and have to manage their costs and just manage to keep the cost down as much as possible, so they maintain their margins on the gold that they produce.
Well, Mark, you're an expert when it comes to gold and precious metals. You've been on the pulse for years now. For here, right now in 2018, what is your latest assessment on gold?
Well, yeah, hard to know. I mean, we we've been expecting gold to break out for a while, and I think most technical analysts have looked at it and said gold's in a bull market, but it's a bit like oil. It's sort of a stealth bull market. The sentiment remains very poor indeed, but I think most people were expecting gold to break out just in the last month or 2 months, but it hasn't. And again, we've seen another quite a sharp sell-off, and for no apparent reason. It's another one of these sort of, when we talk to industry participants, when we talk to our fellow bullion dealers, we talk to the wholesalers, we talk to the mints and refineries and all these people we have relationships with, none of them have seen any selling in any huge significant volume at all in the last few days. And yet gold prices have gone below 1,300 and they've gone below the 200-day moving average. So, it's vulnerable in the short term. Resistance is at 1,360 and then at 1,400. But in the short term, I think we could go below. Some interesting technical research done yesterday by Craig Hemke, and he is a great chart actually I hadn't seen before. And he showed how when the gold price went below the 200-day moving average on two previous occasions, I think in the last 18 to 24 months, that gold prices kept falling roughly another $30 below the 200-day moving average on two previous occasions. So who knows? We could go. The 200-day moving average is around 1305 or so. So that suggests that potentially support could be 1270, 1275, and we do tend to see follow through selling when we see sharp sell-offs as we've seen the last day or 2 days. So we've been nervous short term, but we do think we're going to bottom. 1250, 1270 looks like very, very strong support. And then above that, we think, as I said, 1360, 1400 is resistance. And then once we get through those resistance and if we close above those levels, I think we'll move very quickly to test 1550 and $1,600 per ounce. The record nominal high of nearly 7 years ago, back in 2011, 2012, is just over $1,900 per ounce. And I think we're going to get there in the next 2 or 3 years, just because of the some of the issues that we've mentioned here in terms of the rising oil prices, the potential rise in interest rates, and the stock market's looking quite toppy.
Yeah, no, I agree with you. And one thing I would say is because of the way gold has traded over the last few years, with so many possible breakouts only for it to pull back once again, I feel like the sentiment has been really beaten down, and it's almost as if it's going to take even more confirmation to the upside for the investment community to believe it. And so maybe you could just add a little bit to what you were saying there. Is it going to be even more than those technical indicators that you're talking about for the investment community to really start to believe in precious metals?
Yeah, I think you could be right. The sentiment is very poor indeed, and retail investors in most of the Western world aren't really near the gold market, and I don't think they'll be a factor in driving prices higher, but I don't think they'll be the primary factor. I think that will be more the demand that you see from China, from India, from emerging markets, and indeed from the official sector, from the central banks. But I think it's a good point you make, and I think ultimately it will not be solely price driven. As price will obviously help sentiment in quite a big way. But I do think that potentially you do need, an event, either a very significant geopolitical event, whether it be a September 11th style event, God forbid, or a financial event such as a Lehman Brothers or something like that. So I think it may require, and I'm sorry that they are two huge events. I'm not suggesting events like that are going to happen in the shorter medium term, but I'm talking about an event akin to them, not as serious as them. I think an event like that whereby people see massive risk aversion come into the marketplace, they see a sharp sell-off in the stock markets, and they see gold correspond and act as it does as a hedging instrument, a safe haven asset over the medium long term. That's when I think gold may come into its own again. So you could be right. It may not be solely a price-driven phenomenon.
Yeah, no, I agree with you on that, and it's interesting because I really want to see that confirmation to the upside. It's something needs to spark in gold for us to really have that move that we're all looking for, a confirmed bull market. And I'll say it this way, a fulfilling bull market in gold. Because to be fair, it has come up quite a bit from 2015, December of 2015, but we haven't had that real fulfilling bull market yet, because to be fair, how many people actually caught the bottom in late December 2015, early 2016? So
Yeah.
I'd like to switch gears here a little bit. Thoughts on cryptocurrency, and I'll prompt you with this. Many have made the case that gold has lost its luster to 21st century money, i.e. Bitcoin. What are your thoughts on this?
Yeah, I think it's a little bit too soon to postulate that Bitcoin and other cryptocurrencies is 21st century money. I think it's definitely is showing a huge potential in that regard, and there is that possibility. But I'm a bit of a closet crypto fan myself. I do believe some of these cryptocurrencies will do very well indeed, but I do think that 95 to 99% of them will potentially go to zero. So it's a very volatile space, and I think it's still quite speculative. While I see huge potential in Bitcoin itself and some of the other cryptocurrencies, I do, when people say it's a proven store of value, or it's a proven safe haven, or it's a safe haven form of money, I do question that. I think it could well be, but I think we've only had, what is it, 10 years, 11 years since the white paper. It's a very, very short time span to evaluate something. And the volatility also, obviously, I think rightly it gives people pause for concern. So I think it's showing huge potential, but it's funny. I mean, initially the conversation was that Bitcoin is a new medium exchange, is a new currency, and then when people don't use it as a currency and they can't use it to buy things, or they can but they don't because of transaction times, or because of the huge price appreciation, they don't want to actually spend Bitcoin, they want to save in it. So then an art to change from a medium exchange to a money or store of value. And again, it could well become that, but I just think it's a little bit too soon to say that, So I do think gold and silver are your sort of stores of value, your safe havens. I think equities and real estate are more your classic investments. And I think the crypto, I think I see it more as I suppose a more speculative investment, but I do think there is huge potential. You just need to be very careful in the space and very judicious, But I think Bitcoin itself will do very well indeed, and in time it could well become a store of value. It is showing signs in that regard, that's for sure.
Yeah, no, absolutely, and it definitely does not have the history that gold has. So it definitely takes a little more of a leap of faith to say, which one has the potential to be to go down by 50%. And I think I don't know anyone who would disagree that it's more likely to be Bitcoin. But to the upside, I'd say there's probably more upside in Bitcoin if it does what we are all expecting it to do. So,
well, exactly. It's more about return actually, and I think it could perform very well in that regard. And I think as an asset that you're going to get a return on, gold should be seen as a more defensive type of thing and as a hedge. And you could do very well and make huge returns, but it's not the primary motive for owning gold. Whereas Bitcoin, I think it is a little more speculative, and that way they're actually hugely complementary, and that's why I don't like the whole anti-Bitcoin thing by some gold people and then anti-gold thing by Bitcoin people. It's just too simplistic,
I agree with you. All right, Mark. I believe gold remains money, but many are questioning silver's role as it pertains to its monetary component, especially as we have more competition in the sound money space. Again, going back to cryptocurrency. So, what are your thoughts on silver? Does the silver to gold ratio mean what it has historically meant? Or are we in just a new world where things are changing?
It's a good question, and it's a tough question actually. Genuinely, I'm still actually toying with it, I have my own preconceived notions, and I see very much gold and silver as two proven safe haven assets, stores of value. Silver is a lot more volatile, though, and I suppose what you're alluding to is the fact that silver over years has been even more demonetized than gold. Gold is still owned by the biggest central banks in the world, and indeed the biggest buyers of gold today continues to be the official sector and central banks, but also large pension funds and hedge funds and sovereign wealth funds. Whereas silver doesn't have that monetary role, and doesn't see that demand from the financial and the monetary sector. And it is a commodity that's actually used akin to oil. It's used and it's used in huge amounts of different applications. And particularly, what's interesting in recent years is the demand in the solar sector and photovoltaic cells. So yeah, I think it's an interesting point, and I think the emergence of the cryptocurrencies, Bitcoin and the other cryptocurrencies, I think it has actually, and obviously there was the Max Kaiser phenomenon, and Max Kaiser was a huge fan of silver, and I think a lot of his followers, he sort of moved away from silver when silver prices fell. He's still a fan of it, and he talks positively about gold and silver, obviously, and cryptocurrencies, but I think that there has been a shift in some ways, and those people, they tend to be slightly, I know from even from an age, a demographics point of view, when we look at our clients, the people who tend to favor gold tend to be, the older, and the people who would have nearly all their money in gold or be overweight gold and have no silver would tend to be people in their 50s, 60s, 70s, 80s. And the guys who are more would have be overweight silver or over allocate their portfolio towards silver rather than gold would tend to be people, younger buyers, not the guys in their 30s, 40s, 50s, who would have probably a higher risk appetite and would be more about making that return rather than solely for wealth preservation. So I think that speaks to the fact that some of those guys are more digitally aware and more digitally minded, and I think they have some of them switch their allegiances completely. I think some of them see the complementary element of these things and would own both. And back to your you mentioned the gold silver ratio. I think at these levels we're what gold at whatever it is, 12.80, 12.90, and silver per ounce, and silver I think was as low as 16.40 or 16.50 per ounce today. So it's 1/8 is the price of gold. It remains great value. But I think you're right. I think the monetary element is less the case with silver now than it was before, But I still think it's a great hedging instrument, and I think it will outperform gold in the long term. But it has those crypto characteristics in terms of, I think, performance wise. It could, in terms of return as well. I mean, when silver moves, it really moves, and it went from $4, $5 to $50 from 2003, 2004 to 2011, and I think we're going to see similar type moves in silver in the coming months and years. So and that might help silver regain its I suppose it's people's trust in it again.
Yeah, no, I like what you're saying there. And again, the downside on silver, I think it's limited, especially at these prices. I mean, $16 silver, it's hard to go wrong with that in this current environment, So, but the upside in this environment as well is absolutely huge. Even, and I'm not saying it is, even if it is losing some of its monetary component. The world is moving forward. There's way more debt in the world, and even a small shift from the debt, the implosion of that debt, to sound money vehicles could be absolutely huge for something like silver and Bitcoin and gold, of course, as well. So, Mark O'Byrne, Mark, thanks so much for coming on the show with me today. Definitely let everyone know about Goldcore and what you guys are doing there.
Yeah, well, basically, we very much specialize in the bullion sector. So we do coins and bars for delivery, insured delivery all over the world. We recently introduced free delivery on all orders over $1,000, €1,000, £1,000. And that's what we've been doing since 2003 is coins and bars for delivery. And then more recently, 2008, 2009, what we've really grown to specialize in over the years is allowing people to own gold in the safest way as possible, because we believe both gold and silver are safe haven assets, but they're only safe haven assets if you own them in the safest ways, and you avoid paper gold and ETF gold and digital gold, and you own the actual the underlying physical asset in your name. And as you alluded to at the start, you reduce or eliminate that counterparty risk. So we allow people to own not just allocated gold, but allocated and segregated gold. So your gold coins, gold bars, you own individual coins and individual bars. You'll have the serial numbers of those bars, and your bullion is never, you don't own a piece of a bar, or your coins or bars are not commingled in a giant pile or a giant pallet in a big vault. They're actually kept separate from all the other investors, and you can collect them at any time. You can visit the vaults, inspect them. You can take delivery at any time. You can collect them at any time. Or indeed, what we're working on right now is you can actually just move them from us to another bullion dealer in a very easy manner, and that way we allow people to, you're ensuring that liquidity. Gold is it's a great asset to own, but you need to ensure both the ownership and the liquidity at all times, and particularly in the sort of worst case scenarios that you own gold for. So and yeah, when people own the gold, they own the gold and silver in the safest vaults in the world, in Hong Kong, Singapore, London, and Zurich remains the safest, or not the safest, where our clients consider it as the safest location in the world. And yeah, so that's very much what we do. We're all over social media, and we've got big followings on Twitter and Facebook and YouTube, and yeah, hopefully some of your Crush the Street guys, if they're interested, they can follow us there, and they can get more updates on the gold and silver and the wider precious metals markets.
All right. Well, thank you so much for coming on the show with me today, Mark. I appreciate your time, and I look forward to doing updates with you in the future.
Absolute pleasure, Kevin. Thanks for having me on, and I look forward to joining you again.